the best of Money Matters.
Market View on Money FM 89.3.
That's right, you're listening to Money FM 89.3. Time now for Market View with me, Chua Tian Tian, where we take a look at how the Singapore stock market closed for the day, the biggest movers, sectors, and of course the companies to watch. But as always, a quick recap of how we started. Well, Singapore shares declined this morning despite data from the Ministry of Trade and Industry showing that the city-state's economy grew 4.4% in 2024. Now, the Straits Times Index opened 0.2% lower at 3,873 points after some 90.8 million securities changed hands in the broader market. Now let's take you through the closing numbers. The STI ended in the red as well, down 0.13% at 3,877 points. In terms of value turnover, we are looking at 1.42 billion Sing dollars. Now gainers outnumbered losers, 349 versus 219. Top advances for today, we've got here UOB, New Incorporation USD and Hong Kong Land, and top decliners, we've got here SGX, DBS and Shangri-La Hong Kong dollars. Now, in terms of counters to watch, we have Thai Beverage after the food and drink company's revenue grew 2.4% on the year to 92.3 billion baht. That's around 3.7 billion Sing dollars for the first quarter ended December. Now, elsewhere from the impact of the MAS's proposed introduction of tax incentives to spur listings and investments in the Singapore equities market, to Apple and Google restoring ByteDance's TikTok to their app stores. We've got more local and, of course, corporate headlines in focus. And joining me on the line on the Friday is Benjamin Goh, Head of Research and Investor Education at SIAS. Ben, welcome.
Hi, how are you?
Good. And Ben, let's start with the Singapore stock market as usual. How did the STI fare today, and any surprises when it comes down to the biggest movers and, of course, the sectors that they lie in?
Oh, sure. Well, as you mentioned, the STI was down 0.13%. I would say that's more or less flat, a little bit of noise there. But it was quite a nice recovery from the morning session where the STI dropped down to 3,865 points. In terms of movers and shakers, it was pretty much a mixed bag. UOB as well as OCBC were up. But we saw significant profit-taking in DBS. So given the stellar performance that was announced by DBS earlier this week, that's not surprising that investors may be loading up on UOB and OCBC prior to their earnings release. So if you look at, or rather respectively, you look at UOB as well as OCBC, they'll be releasing earnings on the 19th and 26th of Feb. So, for the people who are a little bit FOMO, if they miss out on DBS, then they might be trying to catch UOB and OCBC.
And zooming in on some of the other companies to watch for today, aside from the trio of local banks, we've got Thai Beverage. The food and drink company's revenue was up 2.4% on the year to 92.3 billion baht, around 3.7 billion Sing dollars for their first quarter ended December. How would you assess Thai Bev's latest performance? How did investors react to the numbers as well?
Yeah, I think the market today was a bit ambivalent, judging by the stock's price movement. The Thai Bev really ended up about 5 cents down, so that's about 1%. So although the company managed to clock in improved sales in its beer and non-alcoholic beverages as well as food segments, its spirits and other segments kind of underperformed. So today's trading volume was actually about the same as its last two average, which suggests that this news is not great but also not terrible. Now, if you zoom out and look at the fundamentals, the consensus target price for Thai Beverage is still at 65 cents, which really represents quite a healthy upside if you go by the fundamentals.
And Ben, I do want to take some time with this one. Two counters to watch for today. They are Singapore Exchange and iFast. Now, what is happening here is that bourse operator SGX and digital bank and wealth management platform iFast, they may be impacted by the MAS, or Monetary Authority of Singapore's proposed introduction of tax incentives to spur listings and investments in the local equity market. Now, two parts to this question. First, what are the measures being proposed over here?
Well, we need to remember that this is just the first set of measures. So consists of three things. So one is the tax incentives for companies to do an IPO to list on the Stock Exchange of Singapore. The second one is tax incentives for fund managers to launch funds with substantial holdings in Singapore equities. as well as the last one, which would be to encourage dual listings in Singapore. So for companies which are listed in other countries, in other jurisdictions, we want to encourage them to list on SGX. Now, if you zoom out, if you look at all these measures in the first set, they are meant to create a kind of a self-sustaining ecosystem. So you've got companies that want to raise funds, they can do that and enjoy the tax incentives in Singapore. And you also have got investors that want to invest in great companies, up-and-coming companies, and they can also do that on SGX. So it's kind of a dual purpose of regime here.
And perhaps the second part to the question, Ben, is that the proposed measures, they were initially thought to benefit SGX and iFast, but on the contrary, we saw the SGX down over 6% earlier as one of the top decliners for today. What are some possible explanations for that, though?
Well, it could be a classic case of buy on rumors and sell on news. So I think the market participants were pretty hyped on the possible reforms in which, which drove SGX stock price to a 17-year high last week. But if you look at the first set of measures, they will kind of address some of the fundamental structural issues in the Singapore equity market, and market participants may have felt that they fell short of expectations. So the knee-jerk reaction is that this first set of measures do not actually materially change the market valuation by themselves. And also what is notable, and I guess not well received in the market, is that there is going to be limited public or direct public funding from GIC as well as government entities like the CPF board. So my perspective is that if you look at it from a purely portfolio management and asset allocation perspective, not explicitly directing GIC and CPF to buy Singapore equities is actually the right approach, right? Because, these entities should be allowed to invest anywhere in the world as long as, they can get to maximize their upside return as well as to minimize risk. That's all good for, stakeholders in Singapore, so like people like me who pay taxes and I've got CPF funds. Well, of course, the flip side is that it doesn't really do anything for the Singapore companies, the Singapore equity market. So that's kind of flip side. If you look at other countries, for example, Japan, so for the last few years, the Japanese government actually invested using public funds, invested in Japanese equity ETFs to help support the local Japanese market. That is not the approach taken by the Singapore government. So, just to be clear, both Singapore's approach as well as Japan's approach all have its merits and drawbacks. Who's to say which one is better? I think only time will tell which approach is going to be better for the long run, in the long run.
Okay. Now, if you're just tuning in, we're now in conversation with Benjamin Goh, Head of Research and Investor Education at SIAS. Well, Ben, let's stay in Singapore. Singapore's economy grew 4.4% in 2024, revised upwards from the advanced estimate of 4%. And the figure also marked an acceleration from the 2023 full-year growth figure of 1.8%. Now, at the same time, we've got the Singapore NODX numbers coming in. It grew 0.2% for the whole of 2024, reversing from a 13.1% contraction in the previous year. Now, what does this say about the outlook of equities, particularly for counters that are outward-facing or export-oriented?
Sure. As you pointed out, the statistics suggest that the fourth quarter results were not as bad as expected, so it's revised up, but still underperformed vis-a-vis the third quarter results. So on the macro level, we do expect the growth in U.S. as well as China to moderate, in this year. But we do also expect that the Eurozone's growth to improve slightly. On balance, there's probably going to be more downside risk compared to upside, chief of which is the possibility of an escalation in tariff regimes globally, simply because of the announcements made by the Trump administration, as well as the unresolved geopolitical tensions in Europe, Ukraine, as well as what's happening in the Middle East. As for Singapore equities, we do see a slight sectoral rotation. So manufacturing and trade-related services sectors are probably going to expand a little bit more slowly compared to 2024. Given what's been happening, I think finance is probably going to benefit from higher demand from regional transactions. Again, coming back to the local scene, retail, F&B sectors, maybe, just okay lah. But, and that's really because of changing consumer patterns, spending patterns, Singaporeans are tending to travel outside for vacations and spending outside. But that could also be offset by higher tourist arrivals, so for investors who are heavily concentrated in pure play retail REITs in Singapore, you may want to consider diversifying a little bit more.
Okay. Now, further away, Ben, all eyes on the U.S. because U.S. President Donald Trump, he has tasked his economics team with devising plans for those reciprocal tariffs on every country taxing U.S. imports. Now, targets include China, Japan, South Korea, and the EU. But that being said, Trump's pick for the Commerce Secretary said the administration would address each affected country one by one and said studies on the issue will be completed by April 1st, which means that chances are those tariffs will be delayed until at least April. How did global investors take in the news? Should we take heart in the fact that the tariffs would not be imposed until at least April, or should we be concerned that tariffs would be imposed? And if that's the case, isn't it priced in for now?
Well, I mean, if you take it at face value, there should not be too much of an impact on Singapore because we have an existing, long-standing existing free trade agreement with the U.S. So most of the imports from the U.S. are already coming in duty-free. But as all Singaporeans and residents know, we do impose tariffs on some items such as liquor, tobacco, petroleum products, motor vehicles. And we also have got outright bans on certain other products like chewing gum and firearms. But the thing to note is that we don't levy tariffs or ban these kind of items to protect local industry. It's really meant to disincentivize or stop the consumption of these items. So Singapore, in that sense, is not protectionist in the classical economic sense. I think more of a concern is that the U.S. has also stated that they will be looking at non-tariff barriers, which include value-added taxes and unfair subsidies. So we do have a 9% GST tax. All right, so that's we call it goods and services, but it's equivalent to a VAT value-added tax in the U.S. And we do grant tax incentives to encourage growth in specific sectors. And we talked about that just now. The new MAS regime to help local companies list in Singapore. So it really depends on how expensive and how broadly the U.S. wants to define non-tariff barriers. Again, with Trump 2.0, anything goes, so we just need to wait and see.
Okay. And finally, before we let you go, Ben, this one, a fun question. Apple and Alphabet's Google, they have restored ByteDance's TikTok to their app stores following assurances in a letter from U.S. Attorney General Pam Bondi that a ban wouldn't immediately be enforced. How would you read into the move then?
Well, I think it's more like a state of execution rather than an exoneration. So as you pointed out earlier in the show, both the Democrats and Republicans in Congress supported the law banning TikTok, and the law was signed into law by President Biden last year. But, if we remember, it was actually Trump 1.0 that brought up the security concern that TikTok user information could be exploited by China. As usual with Trump, it appears that he has now changed his mind. So the U.S. has until early April to address this, or they might want to do something about the law, or, find some kind of regulatory loophole to push TikTok through. But if you don't, then of course TikTok could again be shut down. What is notable is also that ByteDance, TikTok's parent company, has maintained that TikTok is not for sale. So it looks as though there's a little bit of a staring contest because they don't want to sell TikTok, but not sure what Trump is going to do.
Okay.
My perspective is that if TikTok is banned, just go to YouTube Shorts lah. I know it's not the same, but no prawn fish also can. So as long as you get your daily consumption of social media, I think it's all good.
Okay, thanks a lot for the insights, Ben. That was Benjamin Goh, Head of Research and Investor Education at SIAS. Thank you so much for joining us on Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance.